We were quite heartened by the performance of the first effort, which was in October. We raised close to 490 crores in our maiden effort at a time of year which is not normally associated, it's not associated with tax planning. So it was an unconventional time to be launching that first tranche. But we wanted to be first in the market, or as quickly into the market as possible, to establish our presence and name recognition amongst potential retail investors. And now we're coming back for a second tranche, which is a hopefully more appropriate timing from a tax planning point of view, and therefore should attract equal, if not more interest than the first tranche did. So that's broadly the background. The second point I wanted to make was about the nature of the instrument itself, and I'll ask Vikram in a minute to share with you the details of the particular instrument that is on offer this time around. But in an environment in which interest rates are hardening and rising, what the tax-free bond offers is still a very compelling and safe return. We are offering effectively a coupon of 8%, which is tax-free. So depending upon what tax bracket you're in, an investor could actually earn upwards of 17% on a paper that is, to remind people, it's a AAA security. So if you're earning 17% plus on a AAA security in today's environment, that remains, at least to our minds, a very compelling investment, and we hope to persuade the investing public of the same. So those introductory remarks, I'll ask Vikram to explain to you the particular instruments that are on offer.
Thanks, Rajiv. Thanks everyone for coming. You all are familiar with the tax-free infra bonds because there are at least 2 or 3 of these instruments that have been done in the last 2 or 3 months. Our first tranche had 4 different series, but this time around we've simplified the instrument. What we have to offer is really just Series 1 and Series 2. Series 1 and Series 2 of the tranche 2 that we are planning. The face value of the bond is 5,000 rupees. The difference between Series 1 and 2 is really Series 1 is an annual interest payment versus Series 2, which is cumulative. It's a 10-year instrument. There is a buyback at the end of 5 years. And as you know, the way the instrument was framed by the ministry, there is a lockup of 5 years. So there is no liquidity event for an investor for up to 5 years. Post 5 years, since this is a listed instrument, this would obviously trade on the exchange. If they choose to trade out of it, they could trade. We will offer a buyback facility, but that is all at the end of 5 years. The buyback amount per bond would be 5,000 rupees in the first case where the interest payment is annual. And in Series 2, which is a cumulative payment, the buyback amount would be 7,350. The interest rate, as Rajiv said, is 8% on Series 1, and it's on a cumulative basis for Series 2. The maturity date is 10 years, so it is a 10-year bond, and the maturity amount, where there is an annual interest payment, would obviously be the face value, which is 5,000. Where there is a cumulative yield, the maturity amount would be 10,800 rupees per bond. The yield on maturity is obviously 8% in both cases, on a compounded basis in Series 2. The more important thing to focus on really is the next table, which is really what is the tax adjusted yield that an investor gets. And as Rajiv was mentioning, the way investors should look at this bond is, one, it gives them an opportunity to participate in contributing towards infrastructure development in the country. Second, when you look at the 120,000 rupees that they now have available from a tax perspective to invest in tax-free instruments, the 20,000 rupees being available only if they invest in this infrastructure bond. This is a good way to diversify one's own savings into a long-term investment, particularly as it relates to IDFC, because the use of proceeds for everything that is raised in these tax-free infrastructure bonds is for infrastructure. So if you really want to invest with a company that understands infrastructure, then I don't think there is any better entity in the landscape than IDFC to deploy the money that the retail investor is going to invest, where the use of proceeds is restricted only for infrastructure development. Because that's what we do for a living, that's all we've done ever since we were formed in 1997. We understand the infrastructure landscape much better than anybody else does. And therefore, from a retail investor perspective, buying IDFC's infrastructure bonds, where use of proceeds is towards infrastructure development, I think is a very safe investment. Beyond the fact that we are a AAA rated entity. So you get a very safe investment. You are investing with somebody who understands infrastructure better than anybody else does in the landscape. And to top it up, the kind of yield that you get on the bond, as is evident from the table, depending on the tax bracket you're in, to pick the 30% tax bracket for no particular reason other than to just keep the conversation simple. If you were to look at the tax slab for 30%, on a buyback at the end of 5 years, you would get 17.85% return on your investment in Series 1 or 16.3% in Series 2. And if you were to hold it to maturity, you would still get 13.9%, which is the first row of the top table, in Series 1 and 12.07% in Series 2. So by no means are these insignificant returns when you look at the stability and the safety of the investment and the fact that it is a AAA investment. For 20,000 rupees of surplus investable savings that somebody has, if you're able to get these kind of returns, it's a very compelling investment, I would say. So I think the way we look at this is it is clearly a way for government and for all of us who participate in the infrastructure space to directly intermediate retail savings into infrastructure. And we believe a retail investor investing in IDFC's bonds is actually getting, a high quality organization that understands infrastructure, a AAA entity at a tax adjusted yield that is extremely attractive. So with those remarks, the other thing I would want to add is, this is available for investors both in demat and physical form. So last time around when we launched Tranche 1, we did expand it to physically during the course of our offering. This time around it is available right from day one when it opens. So investors can invest in physical or demat form. This opens on the 17th of January and runs up to the 4th of February. So with that, I think we'll open it up to questions if you have any questions on the instrument or anything else that you might want to address.
And everybody is expecting a hike, 25 to 50 basis points. I mean, wouldn't you expect investors to hold on right now rather than invest? I mean, the timing of the issue is. I mean, wouldn't you have waited to time it later? I mean, it would rather be a wait and watch whether the investor's perspective is concerned right now.
Yeah, well, it could be. We'll have to test the market, but we intend to do another issue sometime before the end of the fiscal year. Because it's a shelf registration that we have, remember. So we have the opportunity to keep coming back to the market. And so develop momentum going into the end of the fiscal year.
So that's before the 31st?
Yeah.
Okay.
Now there are two other points to keep in mind. The rate on the bond is not left to us. Okay, it's capped at the government bond rate at the end of the previous month before the month in which you launch. So the rate of 8% that we're offering on the bond is based on where the 10-year government bond was on December 31. Now, at all points in time, you will have a delta between where the government bond is and what deposit rates are in the market. Okay, even if you do it on 31st of Jan, because the government bond is not moving to 9.5%.